Welcome to today's Explainer. We are jumping right into a massive, absolutely game-changing topic today: how to actually capture big, life-changing profits in the markets. We're going to break down the data, the psychology, and the exact mechanical systems that separate the struggling masses from that elite top tier of traders. Because, as our sources make abundantly clear, reaching that top level means completely throwing out the retail gambling mindset and locking into a strict professional blueprint. But first, we really have to face a pretty painful reality. Why is it that 95% of traders inevitably blow up their accounts? That's a staggering failure rate. Well, it comes down to the fact that most people enter the markets looking for action. They want the thrill, the instant gratification, that quick flip. But the sources highlight that this exact desire for excitement is the very thing guaranteeing their destruction. They aren't actually trading, they're essentially just pulling the lever on a slot machine. So we have this massive difference between these two worlds. The retail gambler is chaotic, they're always chasing a get-rich-quick high, and they're completely emotionally tied to every single tick up or down. But the professional system, it's built entirely on statistical probabilities. It's methodical, it's highly rule-based, and quite frankly, it's designed to be boring. Professionals just don't rely on luck, they rely on math. So how do we cross over to the professional side? Well, here's our exact roadmap. First, the probability mindset. Second, the shield of capital preservation. Third, aligning with smart money. Fourth, scaling profits through prop firms. And finally, the data-driven referee. Let's get into it. All right, starting off with pillar one, the probability mindset, which is a total shift in perspective. Listen, professional profits don't come from some single lucky guess that goes viral. They come from executing a cumulative edge over hundreds and hundreds of trades. The sources describe it beautifully as the probability jar. Imagine treating every trade like you're just reaching into a jar filled with red and green marbles. A red marble is a loss, a green marble is a win. If you know your system has an edge, meaning there are slightly more green marbles in that jar, your only job is to just keep pulling. You have to stay completely emotionless during the red draws so you don't panic or quit before you hit the green ones. There's a quote from the sources that hits the nail right on the head here. Big profit requires outcome detachment. Focus on the quality of your execution rather than the dollar amount on the screen. You have to separate your self-worth from an individual trade's result. And this is exactly why professional trading is famously called boring. You might wait hours or even days doing absolutely nothing, just waiting for a single A+ setup that perfectly meets your mechanical rules. Moving right along to pillar two, the shield of capital preservation. This is all about defensive trading. Because honestly, you could have the absolute best mindset in the world, but if your capital is wiped out, you're out of the game. Defense is the true engine of long-term profitability. Think about the seatbelt principle. A stop loss is quite literally your seatbelt. You don't put a seatbelt on because you plan on driving your car into a brick wall today, right? You put it on because if someone else hits you, or the market suddenly goes crazy, you survive the crash. Traders who skip their stop loss aren't braver. They're literally just one bad day away for total ruin. So to survive, professionals live by a really strict mathematical rule. They risk a maximum of 1% of their capital per trade. That's the absolute ceiling. In fact, when pros are trading massive accounts or tight prop firm challenges, they'll often drop that to 1/4 or 0.5%. That drastically drops the emotional pressure and ensures they can comfortably survive those inevitable streaks of red marbles we just talked about. Okay, time for a massive reality check. You know those people chasing 100% monthly returns you see all over social media? That inevitably leads to certain liquidation because it requires taking on lethal amounts of risk. But if you settle for what sounds like a boring 20% annual return, you're actually outperforming 95% of Wall Street hedge funds. Over time, that kind of consistency is what creates real, massive wealth compounding. That brings us to pillar three, aligning with smart money. This is your institutional grade strategy. Once our defense is completely locked in, we move to the offense. Capturing those really big moves means piggybacking on the banks and institutions that actually move the market. The sources break down a specific sequential entry model for this. Step one, identify a point of interest on a higher time frame, like an order block where banks previously left big orders. Step two, wait for a liquidity sweep. This is when smart money pushes the price just past a key level to trigger retail stop losses, basically snatching up the liquidity they need. And step three, confirm the entry on a lower time frame with a break of structure or a change of character, which proves the trend is officially reversing. And there's an absolute law here for professionals. Never, ever guess a reversal. Let smart money trap the retail traders first. Amateurs are out there trying to catch falling knives, while the pros patiently wait for structural confirmation to prove institutional orders are actively entering the market.
Which naturally leads us into Pillar 4, scaling profits through prop firms, or what we call the multiplier effect.
So you've got the mindset, the risk management, and the strategy. How do we turn this into life-changing money? Look, the idea of flipping a $100 account into $1 million is just a myth. The real secret is the multiplier effect of funded capital. The sources point out traders like DC, who made over $900,000 in just 25 days, and Yush, who pulled in nearly $500,000 this year. We're talking payouts up to $2 million. And they didn't do this by risking their life savings. They did it by passing evaluations to manage massive pools of capital from prop trading firms. Think about the math here. If you have a strict mechanical system pulling in just a 2 to 5% monthly return, which is highly realistic, and you apply it to a $100,000 or $200,000 funded account, you're suddenly generating life-changing income. You keep the majority of the profits, and your personal risk is literally just the small evaluation fee. It's a total game changer. Finally, we hit Pillar 5, the data-driven referee, accountability and discipline. To actually keep that funded capital, you need a referee. What does that mean? It's a rigorous trading journal, using tools like EdgeWonk or the EdgeFlow app that exposes the absolute unfiltered truth about your performance. Let's be real. Your brain is going to lie to you. It'll tell you a bad strategy is working, or that a terrible loss totally wasn't your fault. The referee strips away all that emotion and just hands you the cold, hard data. So to use the referee effectively, you've got to do 3 things. First, log every single trade religiously. Second, analyze that data to find the exact setups that give you the highest win rate, your A-grade setups. And third, use structured challenges, like the 90-day psychology challenge from the sources, to forcefully rewire your brain for consistency. You only scale up your position size on the exact setups your data proves are working. All right, let's bring it all together for our summary, Fixing the Human. We've covered some incredible ground in this explainer today, but this summary checklist really proves that trading isn't a chaotic gamble. It's a methodical business. Mindset, treat every trade as a draw from the probability jar. Risk, strictly 1% max risk, always wear your seatbelts. Strategy, align with institutional liquidity sweeps and structural breaks. Scaling, focus on accessing prop firm capital. And discipline, relentlessly journal every single trade. And this really all boils down to one incredibly powerful takeaway from our sources. Making big profits in trading is a process of fixing the human before the strategy. Because honestly, you could have the most advanced institutional smart money framework in the world, but it is totally useless if you don't have the internal discipline to execute it without emotion. The edge isn't just in the charts, right? It's in you. So here's what I want to leave you with today. Are you going to remain trapped in that chaotic cycle of the gambling majority, endlessly chasing those quick wins? Or are you ready to fix the human, do the hard work, and embrace the boring, methodical consistency of the 1%? The blueprint is right here. The choice of what you do with it is entirely yours. Thanks for joining me on this explainer, and keep learning.